Good afternoon. I want to welcome everybody to this webinar off the chain capital with um, President of Off the Chain Capital, Brian Dixon. Before we do this fireside chat, I thought would be helpful to kind of set the stage. We've known these folks for many years, really since the first time we started writing about cryptocurrencies and digital assets in 2017. And I found over the years that the team at Off the Chain has some of the best intellectual property and skills and ideas around generating returns in the crypto space. And if you had invested $100 into this fund at inception, today your returns would have been 25 times. So that means you would have now have $2,500 in a mere 6 or 7 years. I think it's really showing you the power of compounding, especially in the crypto world. And even 2023 is a great example of this. S&P is having an okay year. It's been a rough few months, but the S&P is up roughly 9% year to date. That's actually slightly below average for S&P in a single year. But in that same period of time, Bitcoin is up 110%. So even if you sort of thought you don't really care that much about Bitcoin or digital assets, or you don't really understand it, if you had just a 1% allocation, that 1% would already be improving your equity returns by almost another 100 basis points. So just think about that. It's a small insurance way to actually have diversification. And I just thought I'd have a quick conversation with Sean just about some near-term dynamics. We're still quite constructive on the outlook for digital assets in the next 12 months. I mean, to me, the two catalysts that are fairly obvious, but actually quite significant because crypto is a supply-demand asset, is the potential approval of an ETF that could come sometime in the next few months. I actually want to talk to Sean about that. And the second is the upcoming halvening, which is the block reward getting cut in half. And I guess before discussing this with Sean, I just want to point out today, daily supply of Bitcoin is about $25 million a day. So if we talk about halvening, that means that the supply is dropping to $12.5 million a day. So if you now introduce an ETF, well, that's going to absorb a lot of this incremental daily supply of 25 million dropping to 12. So let me start with that with Sean. So Sean, could you tell us what your sort of best guess is at when an ETF could be approved, like an early window and a late window?
Obviously, that's what everybody's wondering about. And the good news is that window is getting smaller. Right now, upper bound still remains January 11th, which is the final deadline for ARC's spot Bitcoin ETF application. It's very possible that all of them get delayed until that second week in January, and they all come to market all at once. But in recent days, we've seen BlackRock start to potentially seed its ETF, or at least get that ball in motion. Have seen a lot of amendments of existing S1s. And frankly, I think that there's a strong likelihood that we see one come to market within the next few weeks. I think early November is at least in my book a very reasonable expectation.
Right. And Sean, we published a report in July this year talking about potential demand dynamics around an ETF. At that time, I think your estimate was that there could be up to $100 million a day in demand. Do you still feel that that's the case that would come from an ETF approval?
I think so. And now look, it's obviously uh, you don't want to be overly precise with that kind of analysis. But it is definitely well within the realm of possibility. I think it's been exemplified over the past few days. A lot of traders had thought that the ETF was priced in and that there would not be incremental demand come to market. But after that fake headline on Monday, which we wrote about a bit, people saw that there was this existing appetite or a bid waiting for an actual ETF to be approved. And so I think there is incremental demand just waiting for this product to hit the market. And, I think there's going to be a new basket of investors. I'm not sure if there will be incremental flows from people who have historically bought Bitcoin, but I think there will be a lot of new capital that listen to, Larry Fink, label this asset as digital gold and start to treat it as this flight to safety.
Yep, got it. And that makes a lot of sense. I mean, I think I'm just going to point out one last thing and just love your perspective. But to me, in prior decades and eras before digital money, people viewed gold as a decent hedge and diversification. But I think, especially with something like these traditional ETF products coming out, it's going to be easier for people to select Bitcoin as a digital gold and superior in many ways, especially because of scarcity. But what's your take on that?
Yeah, I mean, I think that's the big thing here, right? Accessibility. I think people take. I think people view gold now as this very mature asset that, is this automatic buy whenever there is uncertainty in the world. It's this store of value when global liquidity is increasing. But it was actually a very fringe asset prior to the first ETF being available in brokerage exchanges. It was kind of seen as this, doomsday prepper asset that perhaps could have some use case in the future, obviously has a use case in jewelry and whatnot, but wasn't really a large part of people's portfolio. And now that, this ETF makes it very accessible for RIAs, makes it very, there will be a very mature options market that is built around this ETF, most likely. I think it's just going to be a very easy way for anyone who is looking for a non-sovereign store of value to add, a few bips to their portfolio. So I think it's very likely. And, it'll be viewed as if it's going to be viewed in the same vein as gold, there's no reason that you wouldn't want to own the faster gold with higher growth potential, right?
Yep. Great. Well, I just want to make that introduction. I think you're going to have a great conversation here, and I'm going to turn it over to you, Sean.
Thanks, Tom. Yeah, and so I think now it's time to bring in the man of the hour, Brian Dixon, president of Off the Chain Capital. Brian has been in the space for a long time. He has spent the past decade as a VC. He has, engaged in some blockchain consulting over the years. Has published several books on digital assets. So he is a great voice in the space, and he's going to take you through off the chain story and how they're approaching the market. So Brian, welcome.
Thank you so much, Sean. I appreciate it. And Tom, thank you for your remarks as well. So my name is Brian Dixon. I am the president with Off the Chain Capital, and Off the Chain launched in 2016. And our initial goal is we wanted to acquire blockchain assets at a discount, and that's how we designed the firm. So the firm today is an SEC registered investment advisor that looks to acquire private companies in the blockchain space at a discount and digital asset at a discount. And we do that through two tiers of our strategy within the same portfolio. About half of our portfolio is in private companies, And the other half in the portfolio is in what we characterize as mispriced digital assets. And on the private company side, what we look for is very mature businesses in the blockchain space that have positive free cash flow, so they're profitable. We're looking for them to have minimum or no debt. We're looking for companies that are on a 1 to 3 year pathway to liquidity in our eyes, and ones where we can capture the asset at a discount from forced or motivated sellers. So that's really what we're looking for, is not distressed assets, but distressed sellers of growth assets that we can acquire. And that's going to allow us over time, hopefully with the goal to build performance right at the point of the transaction. And then any additional performance on top of that would be icing on the cake within the portfolio. So if we think through how we do this with off the chain, we really focus on the network that we've developed. And like Sean mentioned, I've been very fortunate to be in this space for a long time. This is actually my 11th year in the digital asset markets. And I've spent over the last decade developing a lot of relationships in the space, and the rest of our off-the-chain team has done so as well. And we have a very solid network. And the majority of the deal flow that we get for our investment opportunities comes to us through our network. And that not only gives us the opportunity for the deal, it also gives us the ability to transact, which is a big differentiator with what we do. Because there's a lot of people out there that may try to get access to invest in a private blockchain company, but if the board of directors and the executive team doesn't allow it to happen, they can exercise their right of first refusal and block the transaction. But because of that deep network in the space, we've been very fortunate to get exposure to these assets and actually be approved to transact. So that's another really important thing with what we do.
Yeah, Brian, if I could just interject real quick, because I think it's important that people understand. So what you're saying is that you have access to these exclusive deals that, other market participants would just not have access to. And we're talking about private rounds, say a Series A round that for a company that might be doing a Series B soon, but you still get that Series A valuation, right?
Yeah, that's exactly correct. And one of the benefits of that is when we're able to get a growth blockchain company at these earlier stage valuations, we're buying ourselves time, because basically we've just de-risked several years of growth and equity value that's been built up in the company. So we de-risk that investment by buying ourselves those years of time, which allows us to capture that asset that's more mature.
Excellent. Yeah, sorry, didn't mean to interrupt, but you're on a roll.
No, it's all good. So I think a great way to think about this, and I'll walk through some examples of each to really illustrate it. So on the private company side, one of our investments that we've made historically is in a business called Polychain. So Polychain is the largest venture manager that exists in the blockchain space today, with billions of dollars under management. And a couple years back, we had the opportunity to buy 1% of Polychain Capital's general partnership. And beneath that general partnership is a family of investment funds, crypto hedge funds and crypto venture funds. And so in the past, what happened is they had an early employee that got into a liquidity crunch and needed to raise capital fast. And he went to the founder of Polychain and explained the situation. And due to our relationship with Polychain, the founder, Olaf Carlson, noted that Off the Chain was the only approved buyer for this transaction. It's the only person at the time that he wanted to allow on the cap table. So he was a forced seller to us. So we were able to acquire 1% of Polychain's general partnership for $765,000. And over the next 2 years, it paid us back over $6 million in GP distributions. And we still own the asset today. We still own the underlying asset. So that's a great example of types of things we're looking for with the private companies. These forced or motivated sellers, they're in a liquidity crunch. We can go in, we can negotiate a great discount deal for the fund, and then we can look to hold that asset and harvest it in the years to come.
That's interesting in this space. So first off, phenomenal example, and I just brought up the deck because I think these slides are relevant, and everybody was sent this deck prior to the webinar. You can look at it on your own time, or you can pull it up and follow along, but you should have it in your inbox. You bring up your investment horizon, your time horizon, but it sounds like a lot of the assets that you purchase, even though you're a liquid fund that offers redemptions, you hold on to these assets, and that's unique, right? I mean, that's not a lot of funds are doing that.
Yeah, so our average holding period is over a year, but we're looking for investments that we're going to hold on a 1 to 3 year timeline. And then we work to balance that liquidity between the private positions in the fund that when we're in larger markets, we'll see those trade actively in the secondary markets for those private stock. So that gives us liquidity opportunities there. And then on the digital asset side, we look to balance that as well to make sure we have adequate liquidity as needed within the portfolio.
Got it. That's helpful to know. So I brought up, I think we have a good view on, how you approach the market, what off the chain is. I don't know, perhaps we want to dive into these slides that pertain to kind of your portfolio composition, asset strategy. We have some more examples of prior and ongoing investments that perhaps you want to highlight. Here we have a slide up about Mt. Gox. I know you guys were big in the Mt. Gox claim. I think there's a very unique position you guys have had that's worth highlighting.
Yeah, so let's chat through the Mt. Gox scenario. So to paint a picture on what Mt. Gox is and its history quickly, back in 2014, Mt. Gox was the largest custodian of Bitcoin in the world with around 850,000 Bitcoin on the exchange. And at that time, that single exchange made up 70% of Bitcoin's daily trading volume. The exchange was hacked and all those Bitcoin were stolen. And so it went under, they had to declare bankruptcy, but they were able to recover 140,000 of those stolen Bitcoin. And then all the customers that were on the exchange at the time were due back a percentage of that recovered Bitcoin, and they became bankruptcy claim holders. So our team developed a relationship with the Japanese trustee and developed a specialized transfer mechanism whereby if we wanted to acquire one of these bankruptcy claims where Bitcoin was the underlying asset, then we could reach an agreement with the seller, provide that contractual agreement to the trustee, and the trustee would transfer ownership of that bankruptcy claim on its books from the seller to off the chain. Now, what that did for us is it allowed us to eliminate the counterparty risk with the seller. And once we developed that mechanism, we very actively went around and started acquiring these bankruptcy claims. And inside these claims, there is 0.18 Bitcoin, 0.18 Bitcoin cash, and about $700 in currency. And in the early days of us doing this, we were buying these claims for $500 a piece. So we were getting $200 for free, we were getting the Bitcoin for free, and we were getting the Bitcoin cash for free in the early days. And we continued to buy these over the years. And we built a large position in this. And as of today, the portfolio is about 24% consisting of these Mt. Gox bankruptcy claims, and they are slated to be distributed to us either before the end of the year or with a current deadline of October of next year. And we mark these assets at a discount on our books, and that discount gets slimmer each year until the assets get paid out to fair value.
Yeah, that was going to be my only question is that, how are these marked, when we're looking at your historical returns, are those marks reflected in those returns?
Yeah, so the increase or the slimming of the discount over time are reflective in those returns specific to this Mt. Gox scenario. And what happened recently is there was an update to when these assets were going to be distributed, and this was talked about in the news. And so when that happened, we had to restructure the discount to then stretch it back out until these assets will be distributed with the current deadline of October 2024. So what that means is people that enter the off-the-chain fund are getting exposure to this Bitcoin with that discount as it's structured at the end of whatever that month end closes that an LP may enter.
Got it. Well, that makes a lot of sense, and it's good to know. And great to know we're almost at the end of that whole ordeal. Just from a casual market participant, I think the lesson here is never become a claimant in a Japanese bankruptcy court.
That's right. Yeah, it's been an extended process. That's for sure.
So here is your current portfolio makeup. I don't know if you want to speak to this for a bit.
Yeah.
It's like we got a pretty diversified set of companies, trusts, etc. here.
Of course. So I'll walk through the private positions briefly to give you an understanding of what we have in the portfolio in terms of private equity. So Digital Currency Group, this is a blockchain conglomerate that wholly owns a series of subsidiaries and has investments in private companies. So DCG's active subsidiaries that it wholly owns today include Grayscale, which is the largest digital asset manager in the world, Foundry, which is the #1 Bitcoin mining pool in the world, and CoinDesk, which is a premier crypto media company that throws the annual Consensus Conference. And in addition to that, DCG has investments in over 230 blockchain companies. We also have BitPay, which makes up 15% of the portfolio. This is the largest payment processor in the digital asset space that offers solutions for merchants and individuals. We have Kraken. Kraken's an international crypto exchange and the second largest crypto exchange in the United States. Osprey is very similar to Grayscale. They issue these digital asset trusts and give people an opportunity to purchase digital asset trusts in the over-the-counter market and things like a retirement account. Mt. Gox, we discussed that. We discussed Polychain before, the venture manager, so we still own the 1% in Polychain's general partnership. And the 32% of the portfolio here that makes up the private trusts, these are a mixture of both public and private trusts, but the benefit we have here is since we own Grayscale through Digital Currency Group, and we own the private equity position as well in Osprey, when these organizations launch a new digital asset trust, Off the Chain gets the opportunity to get a first look at them. And why that's important is because the way these trusts are structured under what's called SEC Rule 144A is that a private trust for a digital asset will launch, a private placement will take place for funding, and then there's a 12-month lockup where you can't trade the asset. Once the lockup concludes, FINRA will assign a QSIP number so that asset can trade in the over-the-counter market. Now, historically, when these assets hit the over-the-counter market initially, for a new asset that wasn't on the market before, we see a premium expand during the bull markets upon the net asset value. So that gives us an opportunity to fund first for the digital asset trust we like, and then our lockup expires first as well. Then we can harvest that premium in the market and use those proceeds to recycle into new value opportunities with the fund.
Right, I think it's a really good topic to point out. Because I think a lot of people are used to living with this discount to NAV and GBTC, right? But not every digital asset has many avenues of exposure now, like Bitcoin does, and so like you said, like you suggest, it is probable that trusts denominated, trusts in other digital assets that come to market should, being that they will be one of the few ways that people can gain exposure to them, should trade at a premium to NAV, like GBTC once used to, when there weren't as many avenues of exposure to Bitcoin. So, and that was not just any premium. That premium was massive. So yeah,
We've seen that over time. I would say we've seen it over time with a lot of the digital asset trusts is that for the newly issued ones, the first time they hit the market, you see a large premium that expands off. Right. Because it's really the only way for the average individual and retail investor to get exposure to it if they don't want to do it through a cryptocurrency exchange.
Yeah. So, I don't know if there's anything else you want to speak to on this slide. Otherwise, we can move on, maybe chat about performance a bit.
Yeah, let's do that.
Cool.
Perfect. So on the performance front here, you can see all of our monthly returns since inception. What this displays is that, one, the digital asset markets is highly volatile. And with Off the Chain, we do the best we can by trying to capture that discount at the point of investment to assist us in minimizing the downside. But it's still a very volatile market. And the cycles that we've seen with this market show us historically that there's several years of good performance, and then we have a steep drawdown year. And then years of good performance, and then we have a steep drawdown year. Now, we don't know if that's going to continue to happen, but that's how these market cycles tend to operate historically. And they operate like this around these Bitcoin halving cycles, which I know will be a topic of conversation that we'll cover as well. And so you can see that the last Bitcoin halving cycle was 2016, 17. We saw a tremendous bull run. We saw a drawdown. Then we had another one in 2020, the years leading into that. And afterwards, we had all-time highs again. Last year in 2022, we experienced a significant drawdown with the blowups of FTX and some of the other businesses that were over-leveraged. And then this year in 2023, we're seeing performance again in the digital asset space. And so we believe that over the next couple years, we're likely to enter another scenario where things will get very interesting in the space because of some of the events that are occurring and because of how these market cycles historically react.
absolutely. And that October 2023 square is probably looking pretty green right now. Unfortunately, not updated yet. I know you can't speculate because you probably, it's mid-month, but I can speculate on behalf of Off the Chain. That square is going to be a pretty green one. So I anticipate this will be a question in the Q&A section. So maybe we just broach the topic now. How did you guys go about approaching the market last year amidst all of the, over leveraged behavior in the market and all of the fraudulent behavior and whatnot? How did you approach that? How did you sidestep all or most of it? What was that like?
So the way that we were able to sidestep the vast majority, there was a drawdown in the portfolio, but what you're looking at here is largely unrealized. And we still hold those assets today. And the reason that is because we had to mark down the private equity significantly after the FTX event and the illiquidity in the market conditions. And so the way that we sidestep most of that in terms of not having a total loss is just with our business model. We're looking for businesses that are profitable, minimum to no debt. And so when we go through a market downturn like this, these businesses can still stay alive and make it through to the other side. And we believe the portfolio of the assets that we have today are going to be incredibly valuable in the years to come. And so that's why we still hold these assets and we're excited about what's going to happen in the coming years. But the biggest thing that happened last year was the illiquidity in the secondary private markets. And then we had to mark down our holdings significantly for that reason. But we still hold those assets today.
Right. That makes sense. That makes a lot of sense. And I think, so here is OTC performance versus Bitcoin. But it's kind of just a rehash of the prior slide. I think the really important slide is this one, that despite all of the, tremors within the crypto market last year, maybe a couple bad months, really, LPs have stuck with you guys. I don't know, it's probably worth speaking to that.
Yeah, so that's something that we've been very happy about. So around 3% of our AUM has been processed in withdrawals. And of that 3.10%, it's less than 1% of our limited partnership base. And I think this speaks volumes to the quality of the investor and limited partners that we have in the fund and the belief in not only the vision of what Off the Chain is doing, but what's happening at large in the digital asset markets. And as fund managers, something that's incredibly important to us is our relationship with our LPs. And so we go above and beyond in terms of communication and transparency, what we do with our partners. Not only are our LPs receiving monthly reporting and quarterly institutional performance reports and a traditional annual audit, we also try to take additional steps to make sure the education and communication with our partners is that much more enhanced. And the way we do that is we generally have monthly Zoom calls where we bring all of our investors on a Zoom just like this. We walk them through the performance for the month. We walk them through updates on the portfolio companies. And we always bring on a key industry leader or executive to speak and educate our partners. So whether that's new technology, whether it's stuff around Bitcoin ETFs, whether that's regulatory and policy changes, we want to make sure that our partners are fully informed about everything that's going on. And in addition to that, we have a closed-ended chat group with just our investor base that's very active. Our investors are constantly sharing articles and exciting new things happening in the digital asset space. And what that's done over time is created an amazing family-like community with the Off the Chain family and our investors. And because of that, I think that's one of the reasons we've been able to retain capital so well.
Yeah, I got to say, I have had the privilege of being on a couple of those calls, and they're really great. It's a very, open format. It's a very, like you said, educational opportunity. I think you have a lot of LPs that are very bullish on, the general trajectory of the industry and kind of get it, but are still very curious and learning. And I think it's a great service to LPs, and it was just great to experience. So co-sign the great your thoughts on the your sentiments on your LP calls. They're really great.
Thank you.
Cool. And so now I'm sure, so now a lot of people are wondering, given where you guys are at and where the market, we obviously think that, we are at the early stages of that new bull market cycle. Are you guys, is the fund open? What does that look like?
Yeah, so right now we have limited capacity to bring in new capital. One of the things that we did at the end of last year after we marked down the private equity in an effort to protect our investor base is we closed off the fund to new capital because we did not want to bring in a bunch of capital with all of these positions marked significantly down and then dilute down the investor base. So we closed off to new capital, and then we were waiting until there was more activity in the secondary markets for the private positions to trade up so that then that would justify us the ability to reopen the fund again. What we did in June of this year is we reopened the fund on a limited basis, and we only accepted in new capital that met the estimated amount of any prospective withdrawals that we had, because that allowed us to manage dilution with the fund. And like we showed before, our withdrawals have been very minimal. And as of today, we have around $2 million that we can allow into the fund. However, with the increase in the digital asset performance just over the last week, I believe we're going to start seeing these secondary markets start trading more actively again. And I think we're going to be able to reopen the fund very soon. And so from that perspective, we'll be able to take in capital again when that happens. And based on the activity I've seen recently, I think that'll happen sooner than later. And one other thing I think it's important to point out about the fund is if you look at the general partner capital percentage, it's 11.6% as of our most recent month's close. And so there's a lot of skin in the game with our investors and a lot of interest that's aligned there.
I was not going to let us leave this slide without bringing that up. I think, in any industry, skin in the game is important, but particularly in this one, where oftentimes there is more uncertainty than not. So that's great. I mean, that number is, normally around 2% for most funds. So, it's hard to overstate how important that is to highlight. Cool. So yeah, as Brian mentioned, there sounds like the, Off the Chain is going to be in a position to take on new capital soon. Obviously, if anyone watching here is interested, definitely feel free to reach out. Should you have any questions or be interested in discussing further. Now I think it's time we get into our Q&A session. We're going on about 35 minutes, so we're overdue. I think I want to kick off the Q&A and just kind of get your thoughts. How is Off the Chain thinking about the market? How are you guys feeling? I know Tom and I kind of just gave our thoughts. We're bullish, etc. How are you guys feeling about the market? What are you excited about?
Sure. So there's a couple things happening, and they're happening all simultaneously, likely in the coming months to coming years. And I've never in my 11 years being in this space seen a major confluence of events that's happening all at the same time before. And what those events are is we have the Bitcoin halving cycle that's usually a bullish indicator with the market cycles that's coming up around April of next year. We have Bitcoin spot ETFs on the horizon, and we have a FASB, the Financial Accounting Standards Board's rule change. So to start off with the halving, what the halving is every 210,000 blocks that are mined on the Bitcoin blockchain is a technical event called the halving. And this occurs approximately every 4 years. And what happens here is it cuts the new supply of Bitcoin issued into circulation every 10 minutes in half. And so as of today, there's 900 Bitcoin being mined into circulation every single day. When the halving happens, there'll be 450 Bitcoin that'll be mined into circulation every day. And what we've seen historically in regards to performance, the best time to be allocating the blockchain assets is the months leading into the Bitcoin halving and then 12 to 18 months following the Bitcoin halving. And the 12 to 18 months following the halving is when we see Bitcoin all-time highs. That's what we've seen in the past. So that's something I think is a very big bullish indicator, and we're going to be entering that over the next couple years. And so that's one of the huge points of these confluence of events that's happening. The next is the spot ETFs that are on the horizon. So if we think back historically, what happens when an asset becomes easier to gain access to? Usually the price goes up. And if we think back to Coinbase, which launched in May of 2012, before Coinbase was in the United States, if you wanted to buy Bitcoin, you had to wire money to an offshore exchange, hope it showed up, and buy Bitcoin there. And at the time, it was exchanges like Mt. Gox or BTC-E. Then in 2012, Coinbase launched and made it easy for a U.S. consumer to acquire Bitcoin. They connected their bank account to it, they deposited some cash, and they bought Bitcoin. It was a very easy process. The next year, 2013, Bitcoin went up over 5,000%. Now, there was also a Bitcoin halving in 2012, but there was another confluence of multiple events, which was Coinbase entering the market, making ease of use better, and the Bitcoin halving. Now what we're seeing with these spot ETFs on the horizon is a major evolution in the next step for that. If you look at BlackRock, Fidelity, and Franklin Templeton, who all have Bitcoin ETFs filing, they alone manage close to 15 trillion in assets. So even if you're a skeptic of Bitcoin and you put 1% of your portfolio in it, it's probably not a bad idea just to hedge your risk in case this really does go in the right direction, for which we're all very bullish about. And if we use gold as a reference point, I know, Sean, you were talking about this earlier. When the gold ETF launched, it made it easier to access gold. Before that, you had to buy physical gold, which is heavy and hard to transport, depending on the amount of it that you had. But in 2004, the first spot gold ETF was offered. It would securitize gold, and it made it easier for investors to access that. And when that happened, the GLD ETF created a 3.5 times price increase on gold right after that. And so if you think that was big, wait till a truly finite asset gets an ETF and hits the market. And I think we're going to see some amazing things happen when that does.
Yeah, and Brian, just real quick to interject. I mean, I would agree with everything you said thus far. I think one thing that not a lot of people are discussing is the fact that you have BlackRock, Fidelity, Franklin Templeton all coming out and competing for AUM, for flows, all at the same time, right? And so, first off, you have this rebranding of Bitcoin, right? You have the Larry Finks of the world coming in and giving Bitcoin, their blessing as a ownable asset, as a legitimate asset, as an alternative to gold. But you're also going to have a lot of marketing dollars put behind these launches, right? Because, the way that the ETF market structure works is that normally, it's a winner take all type situation. And so you're going to have these firms, really sounding the horn on, getting AUM, getting flows. Their sales guys will be out pushing their clients to invest with them with their products. So I just think it's an under talked about aspect of the whole situation.
Yeah, no, that's a great point. I agree.
Cool. And then I think there's one other thing you want to chat about, and that I don't think we've touched upon probably enough in our research, but the FASB fair market accounting rule change. It's possible that this creates some interesting quarterly earnings calls over the next year or so.
Absolutely. So this has not been talked about enough in the media, in my opinion, but it's a major deal because historically, Bitcoin has been characterized as an intangible asset for balance sheets. And the Financial Accounting Standards Board, who is the governing body responsible for writing the rules for GAAP accounting, voted recently and approved a new rule to change Bitcoin's characterization as a fair value asset. So what that means is when historically Bitcoin was an intangible asset, if a corporation bought Bitcoin to put it on their balance sheet and Bitcoin went up in value, they could not show that appreciation. They had to keep it marked at its cost basis. But if it went down in value, they had to mark that depreciation against their earnings. So it was actually prohibitive for a lot of companies to buy Bitcoin or digital assets and put it on their balance sheet as part of their treasury reserve strategy. Now that this new rule is going to be going into effect and being marked at a fair value asset, that means Bitcoin and digital assets acquired for a balance sheet can get marked up or down. And so that's going to actually create a better characterization and financial scenario for businesses that want to acquire digital assets as part of their treasury strategy. Now, this rule is going to take effect in January of 2025, but FASB has noted that companies can adopt the rule early and start using it in January of 2024. And so from our understanding of the space, there is a lot of public companies that have a desire to buy Bitcoin and put it on their balance sheet, but this rule was the reason they hadn't done it yet. And so once this rule goes into effect and companies can adopt it early next year, this is another very bullish catalyst, in my opinion, as to more public companies around the United States acquiring digital assets for their balance sheet, using it as another way to allocate their treasury reserve and a better way to characterize and show that performance within their books.
Yeah. Yeah, no, it's an important point. And, because even though it might not have a cash impact on your earnings, that those intangible asset markdowns are still going to flow through to EPS and, affect, exec comp. It'll affect, your ability to borrow. And so it's a big deal. It's a big deal, as you said. Cool. So let's transition to some other viewer questions. Let's see. I think this is a good question and something I probably should have brought up. And I think there's probably a limit to which you're able to address. But it's been very been a very public ordeal, so worth bringing up. But obviously the Genesis, DCG, Gemini, that whole situation has kind of encountered some legal issues over the past couple weeks. I guess broadly, how does that affect your DCG position to the extent you can discuss that right now?
Yeah, so in terms of the new claim and allegations that were brought recently, that is something that's going to be litigated. The New York Attorney General brought these claims under something called the Martin Act and also some consumer protection laws that have a very low threshold and burden of proof and don't even actually need to prove wrongful intent. And so long term, I don't see that being a big impact to it. I think they'll be able to work through those scenarios. And DCG has been very public that they plan to go to court and combat the allegations because they disagreed with the allegations. And they've also noted that they were blindsided by it. And they were very proactively working with the New York Attorney General's office, providing them all the information that they were requesting through their investigations. And then the case kind of came out of nowhere. What else is interesting is that the case came, the announcement of the case came on the exact same day that Grayscale filed its S3 for its Bitcoin spot ETF. So that's an interesting data point that both of those things happened. And then the New York AG case kind of overshadowed some of the stuff that happened with Grayscale a little bit. But Grayscale in and of itself too, in terms of the GBTC conversion to a spot ETF, I believe that DCG case will have no bearing on Grayscale converting. And I think because Grayscale was not named in the case whatsoever. And so Grayscale will likely still be able to move forward. There won't be any issue there. They'll, in time, once they receive approval, convert that over, hopefully, to a Bitcoin ETF. And I don't see the case being something that's going to create a huge issue long term. And another very important thing is that the allegations in the case, there was no material new allegations. These were things that had already been alleged in former cases and things that are going on. And so because of that, it's not like there was anything novel that they were claiming. And so I think that'll go and get litigated, and ultimately we'll see what happens there. But I don't see it being a huge impact long term.
Yeah, that's helpful to know. And directionally kind of how we feel as well. Obviously, we're not legal experts, but, high level, just the fact that it's a civil case in and of itself seems telling that it's, there might not be as much meat on that bone as people might think. And it's a really good point regarding GBTC, right? We feel the same way. GBTC is its own, bankruptcy remote trust. I think there are some people that think that if Grayscale were forced to be sold, that it would just remain a private trust that do not allow redemptions for into perpetuity. But that just wouldn't happen. So either way, I think I think GBTC is well on its path to converting. So that's helpful though, Brian. I appreciate that. We have a question here about cracking the BitPay. We have someone noting quotes on Equity Zen, which I believe is a secondary exchange for equity. I don't know how liquid that is. Have never transacted on there, but they're supplying us with some share prices. I don't know if should say them because, again, I don't know if they're liquid quotes or who they're from. Could be coerced sellers, buyers, etc. So, I guess are you allowed to say what you paid for Kraken and BitPay?
So I don't want to get into the specifics of price points with them, but I will say is as of right now, these companies, in my opinion, are undervalued within the portfolio from where the true value of the businesses are. But just for compliance reasons, I shouldn't dive specifically into the data points of where we actually acquired those positions at.
Yeah, I figured as much, but appreciate you feeling the question. Oh, I just had this up. We have a question about lockup periods on investments. How does that work? Can you brief us?
So for invested capital, there's a 12-month lockup. And then following the 12-month lockup, there is monthly redemptions with 180 days notice period. So how that works is once you conclude with the 12-month lockup, at any point moving forward after that, if you'd like to do a withdrawal, you provide notice to Off the Chain. And then 180 days later, we process that withdrawal for you. I will say too, though, with our investor base, and I think it goes back to when we were talking about the fund flows and the very minimal withdrawals that we've had, the majority of our investors have a very long-term time frame in mind to be allocated to Off the Chain. 5 to 7 years, I think, is an average amount of what most of our investors are looking to be allocated to the fund, which coincides with our investment thesis of riding this blockchain curve of adoption up of where we think it'll be in 2030, which is a much larger percentage adoption of where it is today. We think it's very possible that we'll see 90% adoption by 2030 in the United States and other areas around the world. And if you really want to see the value in the portfolio, especially with the private side investments that we make, it takes time for those businesses to reach that value. Even in scenarios like we saw last year where we had the sharp drawdown, I do believe things are going to bounce back as we start to see the markets return, which we're already seeing today.
That's great. I have a question here about the annual incentive fee. It's a question asking to elaborate on the annual incentive fee. I don't know if there are any details or mechanics around it that you can elaborate on.
Yeah, so the incentive fee is basically the carry that the fund managers take when we generate a profit. So we work off a high watermark with no hurdle, and that's individualized based on an LP account. So when an investor invests in the fund, that's where your high watermark starts. And then if we generate profits over that in a given year, then those profits, 25% of those profits would be allocated to the general partnership, 75% would remain with the investor. And then if there's an example like last year where the fund did a drawdown, we don't pay out an incentive fee. So we have to generate a profit in and above the high watermark in order for the fund managers to pay out a incentive allocation to the general partnership.
Got it. Great. So, have you ever created an SPV for individual investments you guys make?
So we do not create that, but we have had other investors in our fund that had a group of people that wanted to come in together. So they created an LLC or special purpose vehicle. Those investors invested in that vehicle, and then that vehicle invested into Off the Chain. So that's something we do accept. We don't set up SPVs ourselves. That's just not a business that we're in. But we have had a variety of LPs that have done that.
Got it. But you haven't done any like carve outs, like say you've just taken Kraken. You haven't taken just individual LPs and package that capital into yours and invest in Kraken on a standalone basis, right? Just to be clear.
We have not yet. To be clear with that, we have not done that. However, when you become an off-the-chain investor, if we have excess capacity for an opportunity like that, and we're not going to take it all down ourselves, what we do is we circulate that to our LPs to see if they're interested. And then if they are interested in it, then we would connect you directly with the seller. We don't look to take a fee off that. We just want to provide it as an additional value to our investor base. And so that's what we've done before. So like situations in the past, if we had excess Kraken as an example, and we made an investment, but there was more of it than what we wanted to invest in, we would announce that to the LPs. LPs that were interested would let us know, and then we just make a direct connection to the selling party and let you negotiate your own transaction.
Okay, that's great. I mean, I think that's functionally similar to what Jack is asking here, right? You just don't actually facilitate the SPV, excuse me. Great. Let's see. Really good thought. Well, the private equities. Are there any themes that you guys are excited about? I mean, I know we understand your strategy, understand you're excited about Bitcoin. Anything else in the crypto ecosystem, like DeFi, stable coins that you guys are attracted to or see value in?
Well, I've been spending more time recently in Washington, D.C. around the regulatory and policy aspect. And I think that's something that there's a lot of great technology themes in crypto. But if we don't start to get some sound regulatory policy in the United States, the crypto market is not going to evolve to the level that it can. And so with that, I think you mentioned stable coins. So there's a stable coin bill that's been drafted and is evolving that could potentially go through over the next year or two. And there's also a crypto market structure bill had been drafted. It's evolving as well. And so if we start to see some of those bills get passed into law, that's going to provide a great regulatory and policy framework so that digital asset entrepreneurs and companies know how to build within the regulatory sandbox in the United States. And so that's something I'm actually very excited about because these are starting to move much quicker. And depending on how the election turns out next year, I think that, we can see some of those bills come into law. And then that's going to create another enhancement for the crypto sector as well. And if that does happen, it would also happen with all the events we discussed already, because that's kind of the timeline of how these things are moving through right now to get put into law. And so that's something that I have a lot of excitement around because it really is when you get the regulatory structure that you see the large inflows of institutional capital. And when we see more of the institutional capital inflows into the space at large, the market's going to mature even faster. And that's going to open up the tokenization of all sorts of different things because then we have the regulatory structure to do so.
Yeah, I couldn't agree more. I think everybody was kind of hoping not to comment too much on the current mess in Congress right now, but I think a lot of people were hoping for Tom Emmer to take the helm as House Speaker because he's generally a very technology neutral, nominally pro crypto legislator, and perhaps he would have brought those bills, before the House, this year, but looks like that's not going to be the case.
Well, Sean, something to note on that, actually, we don't know yet until it's actually complete, but another front-running candidate for that is Patrick McHenry. And Patrick McHenry absolutely is a huge crypto proponent, and he's done an amazing work to help further the crypto ecosystem and try to help people understand the regulatory and policy perspectives around digital assets. And so if he ends up being the last man standing as the Speaker of the House, I think that would actually be a very big pro for the digital asset space.
Yeah, I cannot agree more. McHenry's been awesome, has been a great interrogator, we'll say, of our regulators. It's just been a great champion for the industry. I guess in my mind, I kind of wanted, Emmer to bring the bills forward and McHenry to kind of stay on his perch on the House Financial Services Committee, right? Because he's been able to do a lot of good there. But we'll see. Let's see. We have time for one more, I think. We're coming up on the hour here. Okay. Thanks, Jim. Looks like we had a viewer message us, letting us know that Mike Johnson was elected Speaker.
Oh, was he? Okay.
Oh, thanks, Tony. As well. Cool. Yeah, I don't know what his views are on crypto broadly, but good to have an end to that saga. That was something else. Great. Let's see. Any other questions here? Sorry, I'm just scrolling through. A lot of repeats. A lot of these we covered.
Sean, it may be helpful to just point out one thing too. This is something we circle back to what we talked about before on the spot ETF side. So
yeah,
off the chain, we own Grayscale through our portfolio company, Digital Currency Group, and DCG wholly owns the business. Now, a lot of people don't think about this, but Grayscale today is the largest digital asset manager in the world. And their GBTC fund is the largest Bitcoin fund in the world. As of yesterday, they have over $21 billion in that fund. And after they won that lawsuit against the SEC, where the SEC rejected their spot ETF, that was a huge confidence boost for the crypto sector. And we also saw the recent Ripple case where the Ripple won their lawsuit as well, and that was a big confidence boost for the crypto sector. Well, the SEC had a 45-day timeline to appeal the Grayscale decisions, where they got a 3-0 unanimous decision in Grayscale's favor, and they didn't appeal. So then Grayscale filed that S3 that usually you file an S1 when you're bringing in equities to the public market, but since Grayscale's Bitcoin Trust is already a SEC reporting company, they filed an S3 instead. And so it's like a more accelerated path to getting everything in place. And with that, we now know that Grayscale is in very constructive talks with the SEC to hopefully get that approved. And when you think about ETFs historically, usually the deepest and the most liquid ETFs attract the capital. And that's what we saw with gold and a lot of these ETFs throughout history. And for BlackRock and Fidelity and Franklin Templeton, some of the other ones we mentioned today, the only way that they can get their supply to get an amount of Bitcoin like Grayscale has over time is to go buy it in the open markets. And so with the finite supply of this asset, that in and of itself is going to drive up the price of Bitcoin over time. And since Grayscale already has over 620,000 Bitcoin in their Bitcoin fund, they just have such a huge head start to being an industry leader, I believe, when it comes to these spot ETFs.
Yeah, no, absolutely. I mean, look, they already have a 18 billion AUM head start, depending on where we're marking the tape. But yeah, it'll be certainly be interesting to see. I think another huge tailwind for the industry will just be that that discount compressing, right? You'll have basically overnight. I mean, we're back up to about 15% discount to NAV on Grayscale, but if we continue to see the price appreciation that we're seeing right now, and that additional decreasing of that discount, you'll have industry collateral levels go up by 20% overnight. So
you bring up a real good point too about the discount. So when the Bitcoin ETF ultimately gets approved and gets converts, that discount will go back to the net asset value. And I've seen questions in the market around, well, what are people going to redeem from Grayscale when that happens? And at that point, it's like, why would you redeem, right? They already have the most longest track record, the biggest history of doing it. It's now at the net asset value, so it's going to be trading at the spot price of Bitcoin. It's the deepest, most liquid market. And so, I mean, like with any ETF, when it converts, I'm sure there's going to be some types of situations like that where people want to diversify potentially into another provider. But I really do believe they just have such a unique position in the market for what's about to happen.
Yeah, we shall see. But regardless of what happens, it's I have a feeling that Off the Chain is going to be positioned accordingly. Will be positioned well. So, Brian, I don't know if there's anything I missed or anything you want to leave our clients and subscribers with before we sign off.
Yeah, just the closing statements I'll make is, first and foremost, thank you very much to Fundstrat, to Sean, and to Tom and the whole team for having me on. And I really do believe right now in my 11 years of this space that with all these things occurring that we talked about today, it is the most unique opportunity that I've seen over the past decade in the digital asset space with what I believe is about to happen over the next couple of years. And when you layer that on with all the monetary policies, and we're likely at a point where we can't keep tightening, we're going to have to start printing money again, and then we're going to see all the risk on assets go back up. In my opinion, I think it's just a really unique time. And so it may be a great opportunity right now to be thinking about allocating the blockchain assets. So I appreciate it. And I thank the Fundstrat team, and I really thank all of our audience members who attended as well today.
Could not have said it better myself. Thanks, Brian, and thank everyone for attending. If you have any questions, feel free to reach out. But until next time, signing off. Thank you. Have a good one.